Hi, everyone. This is Brent Matthew here, and we wanted to give you a 2020 quarter one update. This quarter was certainly interesting with a lot of things that had happened, and we wanted to give you an update just really what played out in the market, what we saw both in January, February, and then how it finished in March. The virus has all literally had a lot of impact on loss of jobs. A lot of people were sick. It wreaked really havoc on the economy. But let's really take a step back and really see what happened both in the global markets and also in the bond markets to give you a good idea of really what transpired in this time period. Matthew, why don't you start and tell us a little bit about what happened?
Hey Brent, great to see you today. Yeah, so we got a pretty sharp sell-off in all global stock markets beginning early March. And what we have on our screen here is a chart of the major countries that have been impacted by the coronavirus that have the most cases. So we're talking about Italy, Spain, France, Germany, the USA, and China. The Chinese market has held up relatively well. It's only down 8.9% this year. The worst performing markets have not been the US. It's actually been the European markets. We see at the bottom of the screen, brown is Italy, pink is Spain, and green is France. And those markets were down almost 40% at their low, and as of today are down nearly 30%. As for the USA, I know it's scary for a lot of people, but our market held up relatively well comparably, and especially since we do have the most cases in the world. At the lowest point, we dropped 30%, but we have since been on a pretty good rally, and we're only down 14% for the year.
Why is it that you think that China's down the least?
You know, they took really, really strict measures in their economy to stop the spread of the virus, but honestly, their stock market's probably not down that much because they most likely manipulate it.
Mm-hmm.
So they're not a true capitalist economy.
So considering what we've been through, we've done outstanding for the US markets.
Yeah, absolutely. US is doing great, holding up really well. Yes.
So what do we have here?
Now on this side, what we have is we're charting global stock markets. So we put all the stock markets into one index or ETF called the World Stock Market Index. And we're looking at the countries that have been hurt the most by coronavirus and their cases. So world coronavirus cases topped 1.5 million. As of last night, the US had 432,000 cases, which is pretty incredible. And then there's also Italy and Spain, which have a couple 100,000 cases themselves. And what a lot of people are learning is the coronavirus and the stock market are two different things. We've seen cases increase while the stock market has started to recover.
Right. And obviously testing has played a big impact on some of this data.
Yeah, more testing means more cases.
Sure. Now, there's a lot going on with this volatility chart. Tell us a little bit about it.
Yeah, it's a messy chart. I know it's a lot to look at. We'll just follow my pointer here, and we'll look at this middle chart. It's a 5-year chart going back to 2016, and what we're measuring is the daily change in the S&P 500. And in a way, I'd like to congratulate all of our clients and investors who have made it through this month of March, because we saw probably one of the more volatile stretches in history. At its highest point, the S&P had a one-day return of 9%, and at its lowest point, it dropped 11%. And then if we go and look at everyone's favorite, the Dow Jones Industrial Average, it had its best return of the period of 11% and its lowest return of almost minus 13. So some just massive swings in the stock market, really unprecedented.
And this is
throughout history.
And this is probably a good reason why that you don't jump out of the market when something like this is going on, because you could see how massive the up and down swings are.
Yeah, and if you even look at the chart, I mean, it kind of looks like an EKG chart, right?
Right.
And like you just can't predict which way it's going to go every day. I mean, people like to think they can.
Yeah,
but it's impossible. It's like flipping a coin.
absolutely. So what do we have in the bond market volatility?
So we are global investors, as you know, and we run diversified portfolios for our clients, and they know this. And we've been lucky that we don't take a lot of risk in our bond funds. So our bonds have done really, really well since this crisis started, and they've been positive returners in the portfolios. Um, and what this chart shows is how well short-term, long-term, and intermediate-term bonds have performed over the last 5 years, and even into the crisis, we can see they're all up. The bottom chart is showing just how volatile the bond market has been. So that's kind of contributed to those wild swings we've seen in portfolios.
Sure. Sure. And what do we predict, or what do we see is going to happen with the bond market going into the next quarter?
Well, interest rates are really low. I mean, the bonds have really had some of their best return stretches over the last month or two. So I would actually expect them, while they do pay their quarterly interest still, um, to not be as good performers as stocks,
Right.
um, but still adding that nice diversification element for the portfolios.
Sure. That makes sense. So what have we seen in really our modeled portfolios? If we start to look at, the three top models that are mostly utilized and more widely utilized, what do we see sort of in returns, downside effect in these portfolios?
Yeah, so our portfolio has held up really, really well and much better than the overall stock market. So the green line is the S&P 500, and we can see that it hit a low of 30% down. And our worst performing portfolio was the global balanced, but it's not like it was bad performing comparatively, right? It lost at its peak 20%.
Correct.
So that's not bad at all, considering stocks were down 30,
Right.
right? And today it's only down 11. If you were a little bit more on the conservative side and you were in a 40% stock portfolio, the low return was minus 15, and today you're only down 7.
Hmm.
And then for people who are ultra conservative and only had 20% of their money in stocks, they didn't even drop 10%,
Right.
minus 8%, and today it's at minus 3.
To put it into some perspective also, and to give everybody an idea of why volatility was less in each one of these portfolios, is because the percentage that each one had in bonds is higher. So if you look at the top one, the top line that's down only 3.5%, there's 80% in bonds. And we just saw on the previous slide that the bond volatility was low. Bonds kept that portfolio from really dropping. I mean, obviously the long-term rate of return in a 20% stock portfolio is much lower than if you looked at the third line, which is a 60-40 and dropped 21%. But what stopped it from really dropping to 30% negative is those bonds in that portfolio, which is why you don't have a 100% stock portfolio. It's why most people who are planning for either retirement or they're going to utilize some of that money for income for business reasons or what else. They don't want 80% of their money into stocks. So these portfolios really did hold up. And I know I think it was March 23rd or 25th, Matt, what was the low point? Do you remember what the date was?
Yeah, I believe it was Monday, March 23rd, but I don't
Yeah.
have a calendar in front of me to check.
Yeah, that's exactly when it was. And everyone, at that point really started panicking, but that was really the bottom of it at this point. So what do you think about the economy, Matt, and where things are going right now?
Yeah, well, if the stock market has started to move back up, the economy is going to be a different story. And I think a lot of people are going to learn the lesson that the economy and the stock market are two completely different things.
And what do you think will happen over the next several days and weeks?
Yeah, so what we've seen happen is we know we've heard about the Federal Reserve and they're cutting interest rates, right? Well, they cut interest rates all the way back to zero. So they responded very fast to this crisis. The president, Jerome Powell, has been saying that he was very nervous about this, and he's a massive impact on the economy. So the Fed funds rate was shut back to zero, And the impact that's going to have is on savers. So we're going to see those high yield savings accounts that were paying, 1%, 2% in the summer of 2019. Those are going to be dropping. And then we're also going to see investors who like CDs. Those CD rates are going to stop dropping. And then I know you have some thoughts on annuities, which are also probably going to start dropping on those cap rates, right?
Yeah, cap rates are going to start dropping on annuities. The fixed rates are going to start dropping on annuities. I mean, obviously, people need to stay away from commission-based annuities because they're just going to absolutely start losing and getting adjusted in their rates. And the last thing you want to do is enter a 10-year contract with rates like this right now.
Yeah, the insurance companies are going to be in trouble with those rates for sure.
Yeah, absolutely.
All right. And then on this slide, I think it's really important for people to see. I mean, a lot of our clients are retired or they're getting close to retirement age. So they're in a little bit different of a mindset than the majority of the American population. But really, the amount of people applying for unemployment in the last 3 weeks has been unprecedented. So this is a chart that goes back to the 1960s and it shows people filing for unemployment. And what we could see here is in the last 3 weeks, 6 million people have filed for unemployment. Previously, the high was around 1 million, and that was back in the 80s.
And they expect it to go into the teens now, right?
Yeah, they do, and we're probably looking at least in the short run, an unemployment rate, approaching 10 to 20%. A lot of these jobs are kind of service-based jobs, right? Hotel workers, restaurant workers, airline staff, who are getting laid off. So we're hoping that they do get rehired once the health crisis is over. But just truly unprecedented. This is something we're going to tell, our kids, our grandkids about that we lived through in 2020.
Yeah, I mean, it's incredible. I mean, you have a chart here that's 50 years in length, and there's nothing been even close to it. I mean, this is just incredible, the amount of unemployment that there is right now.
Mm-hmm.
So any parting thoughts, Matt, about what you sort of saw this last quarter?
I think that it's important for people to understand that what we're going through is a health crisis. It's not like 2008. It's not like 2000. It's not like 1987. It's not even like the Great Depression at all. The economy was perfectly healthy and doing great until this virus came. And that's what's wrecked the economy and made the stock market drop. So it's not a financial crisis.
So as we head into this last quarter, I think the message is, just be prepared for more uncertainty and more big news coming out of the economy. I mean, you have to imagine either some companies either go bankrupt, fail, or some companies need more stimulus from the government to be saved. There's going to be things that probably happen. So don't be surprised if those things do happen. But, we don't sell portfolios off when we're in volatile times. We just rebalance. We do the smart things that we've talked about in the previous videos. And so we wanted to give everybody an update. That's where we're at right now. And we'll keep you all updated as we enter and finish into the second quarter. We wish you a very safe and healthy Q2 of 2020.
Thank you. Stay safe.